Yep.
And then that's the Northern Cobar Basin. So,
Which is where Aurelia Metals
yeah,
have
so
got a lot of
Pete's there,
operations.
CSA's there.
Well, ladies and gentlemen, it's a bit of a different touch. As you may be aware, I am actually at the office of Kingston Resources today, 21st of March, Friday. And this is the Managing Director, Andrew Corbett. Andrew.
Ryan, thanks. And thanks for coming in today.
Yeah, thank you. Initially, I was thinking of doing a recorded conversation via Riverside, but then I was going to be on my way to Chatswood, and I thought, hey, North Sydney's just right in the way.
The corner.
Yeah, and it was right next to Victoria Cross Station, which is a new metro line that Sydney finally has, as opposed to just the trains.
Yeah.
Runs much faster. Runs like Hong Kong. Have you been to Hong Kong before, in fact?
Yeah, absolutely, multiple times. And I use that metro all the time. So if I've got meetings in the city,
yes,
within 10 minutes, I'm at the meeting in the city.
Yep.
So it's fantastic setup.
And you know that all the settings is very much like Hong Kong. I actually am quite surprised because the Sydney trains themselves are a totally different story, and I hope that they're going to refashion it and make it more frequent, make it more efficient, and make it more comfortable.
Make it a metro on the surface.
Yes, exactly. Well, actually, I'm not sure about whether that might. You still got the weather causing the tracks to buckle, isn't it?
Yeah,
Wouldn't that be the case?
Yeah, I'm not sure. I'm sure there'd be practicality and issues around that.
Yeah.
Yeah.
Well, we're not going to just be talking about transports, trains, and all that, but we're going to be talking about something related to it, the materials that are used to build the cities and all that, metals. And Kingston Resources is producing metals, gold, silver, and copper in particular, I believe, and there'll be a few more lined up as well. So the reason why I'm here is you have an update for us about what's been happening in the last 3 to 6 months, and also the strategic plans and what to expect for the coming quarter and coming few months. Now, just to let you know, in Gold Stock Pro, we have at least 700 readers who, plus also our alliance members who pay for the full across the board suite of newsletters. So there's probably about 3,000 eyeballs going through.
It's getting big.
That's right. And Kingston Resources is one of the top 5 holdings in Gold Stock Pro. I think it is ranked number 3. And we currently have like about 10-15% of the people who hold Kingston Resources as the largest holding in their portfolio of the explorers and early stage developers, as well as also companies that became producers, of which you were one of them since January 2022.
Yeah. No, that's great. And I mean, we've got 3,500 shareholders, so it's really good to have more support, particularly from the mums and dads and the retail guys, because that's what our support base is. I mean, we've got 4 big shareholders, and then it's 3,000 mums and dads, which is fantastic.
Yeah, and I know the liquidity of the stock is, even though it's liquid, but the trading volume still remains relatively low these days, and that might have contributed to the price. And of course, Kingston Resources, I think the investors have been treating it more as a copper play more than a gold play at the moment, but that could change given that at the moment I understand Mineral Hill produces gold and silver.
Right now, just gold and silver.
Yeah.
Copper's about 12 months away.
Oh, okay.
A bit over 12 months away.
Yeah. So could you tell us a little bit about how the ramping up of the Mineral Hill production is? Because I remember last year, until last June, the company was producing from the tailings, and now you're digging into the ground, extracting the rocks, and it's running through into the mills. And I noticed that the head grade, as in the grade of the ore going through the mills, are actually slightly higher than what we're seeing, but still not quite where we're at.
Yeah. No, absolutely. So if you think about the history of Kingston, 2016, 3 people. Here we are today selling and producing gold and silver. There's about 140 people between New South Wales and PNG. So there's a few people up there too. So I'll talk about PNG as well. What I can talk about.
Yeah.
So hard rock mining, first full quarter was last quarter. We did about 3,200 ounces. what people should be looking for is an increase quarter on quarter in production.
Yeah.
Which will obviously drive costs down.
Yes.
So we're a very fixed cost business. Owner mining, so we know month to month what our cost base is, and that's one of the big advantages. So we should see an expansion in margin, and then on top of that, we're selling gold at probably $500 an ounce more than last quarter.
Wow, so you're talking about probably 4,600 because it was 4,101 last quarter.
So 3,200 ounces at 4,100.
Yeah.
So obviously an increase. I'm not guiding to the number.
Unhedged, and then that's where it
so looking for an increase. We're really trying to finish this quarter at the 20,000 ounce per annum run rate.
Yeah.
So that's what we're pushing towards. And then we think we've got a bit more to get out of it then to hopefully get to that 25,000 ounce run rate.
Yeah.
So that's what this quarter and next, but margin expansion on gold price and on lower costs because we can produce more. So that's what people should be looking for. The pits run currently for another 12. Well, we process the pits till May, June next year.
Yeah.
So we've still got, 14, 15 months of open pits. And then the underground development will start in February, first quarter next year, so February, March next year, calendar year. And processing underground will be sort of end of the second quarter next calendar, so June-ish.
Okay.
And that's when the copper production starts.
Right. So maybe I might correct me if I get anything wrong, but is it correct that is it Pierce North that the open pit ore grade for gold is slightly higher than the underground ore? Or is that more the resources but not the reserves?
Yeah, no, the mining grade from the underground in copper terms is like about a 3% copper equivalent. So
that's really high.
Quite high.
Yes.
Yeah. So the underground's margins should be very good. We just that's next.
Yeah.
The open pit dirt is it should be 2.5 grams, which is where we're heading to.
Yeah.
If we can push it above that 2.5 gram, it's going to be good. But we have lowered the cutoff grade from the original reserves.
Yeah.
Driven by the gold price.
Right.
We just need to we don't want to be leaving anything behind right now.
Yes, that's true.
Because the pits have a finite life, they don't go very long, and whatever's in that pit shape above 0.8 is now going to the mill. Whereas we thought we were going to do it at about 1.2, but we've dropped it down because of the gold price. Everything's going to the mill, which gives us more tons to process and produce more ounces. But it's a great opportunity. It is not often you can ramp up with a tailwind like we've got with the gold price. I mean, look at the lithium guys and the nickel guys. Right?
Yes.
They're trying to bring one of those projects online right now.
I know. That's why quite a number of those companies have been moved out of the ASX ordinaries, and the gold mining companies are actually being added on in the most recent quarter.
Very interesting. Yeah. So that's happening. So let's just recap. When we picked up Mineral Hill, we had 18 months of tailings retreatment.
Yes.
That's 3 years ago now. And today we've got 6 years ahead of us already. So we paid $23 million for this asset. The tailings produced $100 million in sales and $26 million in operating margin.
Yes.
Open pit in the first quarter delivered $6 million of operating margin. So again, you should be looking for an expansion on that next quarter.
Yeah.
In a year's time, not only will we pay, we've already paid the purchase price off. We're actually going to pay the plant refurbishment and the underground restart capital. So to me, that's looking after shareholder returns. We've got to get a return on the investment and on the asset. So, and I think people are looking for, and I think my view is this is really important. People want to see our cash grow quarter on quarter.
Yeah.
And that's what we're working very hard to do today. At the group level, people want to see our cash go up.
Yeah, that's true.
And that's really our number one mission right now.
So I think in the case of Kingston Resources, it's been a lot of pain before gain because we've noticed, for example, the company's raised, I think in the last 12 months, about $20 million.
Yeah.
And that was because, firstly, last year, the market was only just starting to pick up with gold. Like gold started taking off after the March Federal Reserve meeting. and the smaller end of town, the small producers, they were only starting to pick up a bit of interest, and you took that opportunity to make sure you fully fund the restart of Mineral Hill, rather than run into the trouble of ramp up difficulties, have a little bit of debt, and then end up running yourselves into the ground, which is what we've seen with, say, Caldas Resources and Dayston Gold before, Waluna Mining. There's just and of course Gascon Resources until they became Spartan Resources. Like you were ensuring that make sure everything is in place, even if the shareholders are a little bit upset. But at the same time, I've always reminded my newsletter readers that that Mineral Hill tailings, processing the tailings, initially there was a expected 3-year production life, and you expanded to 6 years. So for me, that sold it to me. Whether the rest of the investors in the market don't get it, I don't mind, because that just gives us the chance to buy low. And when everyone suddenly realizes, hey, oh wow, this company is right there. They're profitable. The operating cash flow is positive. The only reason why the cash balance is coming down is because there's costs in developing, costs in refurbishing, and once that's out of the way, the money's just going to start rolling in.
And so you think about it, so in that last year that you talked about, we spent $13 million on the plant, and there's $5 or $6 million in waste stripping with the pits, right? So we needed to do it. It was painful, and I don't like raising equity either. It's the hardest part of this job. But we're through that. Now it's about showing cash generation and growing our cash balance. So that's where I think we're at, and I intend to show people that this quarter. So to me, that's no one really believed we were going to make money out of tailings. We did. No one really believed we were going to spend $13 million to get this plant running for $13 million. We have. Now I need to show people we're making cash, and I think it's 3 points. He said this and he's done it. He said this and he's done it. So that's I think really important. So that's what I think is strategically really our number one priority, alongside advancing Misima, sorting out getting a return for shareholders from Misima is the equal highest priority alongside Mineral Hill right now.
And we'll definitely get to Misima, but with Mineral Hill, there are a few things that I also still want to ensure that I fully understand what's going on. What's the progress with the processing plant and the flotation plant development?
So right now today we're still producing doré, gold bars, gold and silver bars. Our bars are quite interesting because they're about 13 to 16% gold, and then a big chunk of silver. So when you send them, they look big, they're heavy, but there's a lot of silver in them. So currently doing that. The float plant is now fully wet commissioned. I was on site on Tuesday. That's the beauty of being in North Sydney near the asset. We run water through it. It's ready to go. We don't actually have enough blue rock yet. Because the transition from open pit from oxides to transition, so red dirt to blue dirt, is underway.
So blue dirt is the sulfides.
Sulfide. So we need to get to the blue rock.
So that's copper sulfide.
No, this is big gold and silver. No, it's not.
Oh, okay.
This is not copper.
So as long as there's some, because when I did chemistry, I understood that iron sulfide and copper sulfide are blue. I didn't actually know that silver sulfide is also blue.
I just call it blue rock.
It's just so it's not exactly blue.
It's not exactly necessarily.
Right.
But it is grey blue. It is. So once we get enough blue, sulfide ore, I'll call it sulfide ore, on the ROM, then we can actually commission the plant. It's actually a real positive that we haven't needed the float plant. We've just kept everything going through the CIL. Recoveries have been in the 80s the whole time, right? Now, they will tick down. So shareholders and investors the recoveries will tick down, and then we switch the float plant on. And that's driven by the geology and the metallurgy, right? So that's happening. So the float plant's ready to go. I expect May, June, we will fully commission it. But that will be just gold and silver concentrate.
And what types of grades are we going to be talking about? Because the last 2 quarters, I think the head grade was about 1.3 and then 1.54 in the most
no, it'll be
recent
in
one.
the twos.
Okay,
Yeah. No, basically from the end of the last 2 months, I think of this quarter will be in the twos, and then from that point on, it'll all be in the 2 to 2.5 range.
Oh, that's excellent, because that should take the all-in sustaining costs to at least the low 2,000s, if not even the high 1,000s.
Yeah, it'll definitely push them down. That's right.
Yeah.
So gold concentrate, gold and silver concentrate. So we're about to sign an offtake agreement for the first 6 months. So that'll all happen. This plant's done it before. Remembering that one of the pits is half mine, pits south. So that used to be a gold and silver concentrate.
Yes.
So we're basically just redoing that again. And then so from May, June for the next 12 months, it will be gold concentrate sales and a little bit of still gold doré sales. We're still, the CIL will always be running. So after the float plant, once the ore goes through the float plant, it comes back around and then through the CIL. And because you get another 10 to 15% gold recovery through the CIL once it's gone through the float plant. So the recoveries will be in the mid-70s, basically, for the rest of the mine life of the pits.
Is it because of the nature of the rock that's particularly hard in that area, and if it's softer,
the gold's
it would be
associated with arsenopyrite or pyrite.
Oh yes,
yeah. So the pits are slightly refractory, which is why the recoveries drop. But that's we've done all the network, and so basically we'll get that 70-75% recoveries, because of the gold's bound up in the mineralogy of the rocks.
Right.
Yeah. So you've got to float it. And that's just how you've got to treat it.
Okay, right. And so how's the exploration drilling coming along? Where are the places that you're now focusing on to try to expand the resources and reserves?
The priority right now is underground.
Yeah.
So we've got one diamond rig in the underground, and that will stay in the underground at least for another 2 or 3 months.
Yeah.
Its number one thing right now is adding mine life for the underground.
Yeah.
So it's drilling in the underground, currently G and H low, which are copper and gold dominant, and we've done some holes in A low. So news flow will start to flow around that in sort of April as well. Mm-hmm. So we'll start to put results out. It is infill and extension of our current resources.
Yeah.
So it'll add, but also most importantly, conversion from resource to reserves.
Yeah.
We want to get more into the reserves.
Yeah.
So that's the priority there. It's about a 3,500, 4,000 metre program. I think we'll have a short pause and then keep going.
Yeah.
Because we've got a lot of drilling we want to do.
Yeah.
And so then on top of that, we're also getting our first surface target worked up and getting that ready for approvals, and that's Bogon. It's about 1 kilometre north of our ML. So very just to the north, sort of just got to think about this, northwest of us, of the processing plant, very close.
Okay.
So that's our first exploration target that we want to drill from surface.
And your mill currently has a capacity of 750,000 tonnes a year, is that correct?
Sorry, we're approved. It's actually 700, so we're approved for 700,000 tonnes.
Currently 480, is it?
Currently at 360, so 1,000 tonne a day is how you should think about it at the moment.
Yeah.
We have plenty of crushing capacity, and we have plenty of capacity in the CIL.
Yeah.
Where we're constrained is in the grinding and the float circuit. But right now, we need to get more mine life and increase our tonnes and our mining inventory to support an expansion of the mill.
Yep.
That's number one priority.
Right. And in the vicinity of Mineral Hill, are there any other companies or any other deposits that are close to production that it might justify them using your processing facility, or alternatively, you guys decide to do a deal where you want to take ownership of it? Because what other mills are there within the 100 kilometre radius?
We are the only in that Southern Cobar.
Yes.
So you can see Mineral Hill there down here. We are the only operating plant in that Southern Cobar.
Yeah.
Tommingly's sort of over this way.
Yeah, right there.
Yeah, that's probably the other. That's a CIL, but that's not. So that can't take base metals.
Yeah.
So Mineral Hill sits here, and then Peak is
Peak is
The
there.
next one up. That's the next.
Does Warner Winter Managing Resources have a processing plant on site? It's a very tiny one, isn't it?
No, it's not a full plant. It's not
Yeah.
fully operational.
Right.
Hasn't been turned on for years.
Right.
It would need money and work spent on that. So because if you look at where we are in this
Yeah.
southern basin,
Yes.
within 100 k's of us,
Yeah.
we are the only operating plant.
Okay.
So even 150 to 200 k's, we're probably still the only operating plant. Yes, there are stranded resources.
Yeah.
We are looking at a number of them. We're talking to a number of them.
Yeah.
It doesn't mean we have to buy them.
Yeah. You could do.
We can do earnings on them.
OPAs.
We can do JVs on them. You know, my view is whoever's got the mill gets a lot of the economic rent.
They do.
Right.
They
So
do.
I want to use that, and that's why that's good for Kingston shareholders.
Yes.
So yeah, obviously very, very focused. I'm very focused on gold and copper.
Yeah.
And keeping our gold. They're the two valuable metals, right?
Yes.
So in our mine plan, they are over 80% of our production.
Yes.
And in fact, if I put spot commodity prices today, gold is actually 50 to 60% of our production over the 6 years, just because it's run so hard.
But why would you be expressing your production as a copper equivalent? Is it because back then the expected production?
The underground used to be a copper equivalent mine. It's actually one of the conversations we have a lot internally.
Yes.
What are we going to be? Are we going to be a gold equivalent producer or a copper equivalent producer? We haven't landed on an answer.
Because I think that's a mystery.
I agree.
Yeah.
But I think at this point it's a gold story.
Yeah.
Gold's more than 50% of our revenue now, and I think it's going to be all the way through. And I'm very focused on keeping that up.
Yes.
There's a lot of guys that are talking copper, and I love copper. I think copper's a great story.
Yes.
But I think the copper gold balance is really important.
Yes.
Keep them both up. You know, I'm less worried about lead, zinc, and silver. Silver could double here.
Yes.
And it's still not.
There is something going on, and I can't quite put my finger on it, because silver broke above $30 an ounce last year in around May, first time in 12 years. And now we're just waiting for it to break above 35. I personally think that when silver breaks above $35 an ounce, that's going to create this FOMO onto smaller gold stocks. And it's just frustratingly not getting there. Yeah, yes. Exactly. And it just dropped back yesterday overnight to about 33.30. It was just above 34 yesterday.
Right. Yeah. So, I mean, I don't know. I don't know what drives the silver market.
Yes.
But I do think you're right in that when silver runs, the juniors run.
Yes.
Regardless.
Exactly.
For some reason. So I'm looking forward to that as well. But even if the silver price doubles, so silver today is 10% of our revenue. If it doubles, it would go to 15 or 20% of our revenue right now. That's great. Fantastic.
Yeah.
The silver today pays for head office and Misima.
Right.
More.
There you go.
On a monthly basis.
Wow.
Yeah. That's important, right?
That's not something that I could have picked up when I read the quarterly reports.
But, So if you think,
you've got yourself a very interesting tidbit right there.
Yeah. So if you think about it, so if we do 1,500 ounces of gold, that's $7 and a bit million at the moment, probably 7.2, 7.3. There'll be another $300,000-400,000 in that month of silver.
Yeah.
So that's sort of where we're heading, which is so relevant. It's important for us, and very helpful.
So that area in New South Wales is largely gold, copper, silver.
Well, if you think about it, you've
lead,
got
zinc.
Talisman drilling right next door to us, 11 k's away with Durnings. Very early days, and I hope they hurry up and drill. That's fantastic. You've got the Achilles discovery.
Yeah. So
that's interesting. That's silver is dominant, silver gold maybe, which again, the CIL at Mineral Hill is perfect for. So that's good. And it's obviously got base metals in it as well. So the float plant. You've got other assets. You've got Peel's assets. They're interesting. There's a couple of smaller stranded gold resources that we're aware of in listed companies that are all interesting.
Yeah.
But I really do feel right now demonstrating cash flow
and
sorting Misima out
is
more important to shareholders today and this year
Yes.
than us putting our foot on another resource, because we want to get our paper up. We want to get the shareholder return up before we go and put our foot on another resource. So that's how we're thinking. And the board is sort of saying, we've had these two assets now for a while. We're not Mineral Hill 3 years missing them since 2017.
Yes.
It's time to get value.
Yeah.
So that's the priorities.
So let's now board the plane and fly across the Arafura Sea into PNG. What's going on with Misima at the moment?
It's hard for me to answer a lot of questions.
Yes, I understand.
Because you would have seen us, we put out effectively a cleansing statement announcement the other week.
Yes.
The process is ongoing.
Yeah.
We are very busy. I'm under CAs with so there's no conversations that I can talk to.
Yes.
It's a very interesting time. The gold market is hot.
Yes.
You just have to look at the Bullabulling transaction. 160 million. It's a 1 gram ore body in Western Australia, right?
Yeah. So just a bit of context. Bullabulling, it's MI6 Resources is now trading holds, and as they go through, I think, a recapitalization in order to fund the
$220 million capital raise.
That's almost like it's a snake swallowing elephant type of transaction, that one. And also Ramelius Resources and Spartan Resources earlier this week.
De Grey, Northern Star, Ramelius, the West Gold, Kokora, Ramelius, Spartan.
Yeah.
This Bullabulling transaction. So the gold market's hot.
Yes.
So there's interest, right? So from that, you should understand that there's a lot of interest. There aren't many assets of this scale.
Yes, it's a big one.
20-year mine lives that can do 130,000 ounces per year.
Yes.
There are expansion options and studies that could push this project to 150, even as much as 200,000 ounces per year. So there's interest from that point of view. Then once you've put your geopolitical risk or country risk on it, it's not going to get the same premium as a Bullabulling.
Yes.
But there's value in it. So what are we looking for? So if you think about it, we've spent $46 million.
Yes.
We want a return on that.
Yes.
We want exposure to the 20-year mine life in some form, some carried form. So that's also what we want.
Mm-hmm.
Personally, I'd love to build it.
Yeah. But
I'm realistic. My job is not building mines and producing gold. My job's shareholder returns.
Yes. So it will cost probably around 500 million.
500. You get no change
nowadays.
500.
Yeah.
470 is the plant, and you need another 20 to do studies and drilling and get ready and all that sort of stuff. So it's a $500 million build. So that's not for us. So let's watch this space. I would like to have something done this year.
Yeah.
And that then could unlock this strategic opportunity in New South Wales.
Yeah.
Because we'll have hopefully some value in the paper. We'll have a strong balance sheet. We'll be producing cash. We can move to an expansion study at Mineral Hill. We could start to look at other resources. Then does it open up bigger corporate things? We'll wait and see. But I keep saying to the team, this is a transition year for Kingston.
Yes.
I'm using that with shareholders as well. It's a transition year to free cash flow generation, to unlocking value in Misima. We're deep value.
Yes.
It's not much fun being deep value.
I know. That was it's interesting because when I first recommended the company to my readers back in May 2021, it was Misima.
Yeah.
And it was a punt because the idea of a $40 million company with that big a deposit trying to build it is a pipe dream unless there is something that happens, either a massive gold bull market suddenly brings a company up to $100 million just by the sheer interest of the market, so that you could raise maybe $20-30 million of capital and then do a bit more drilling or do a bit more negotiations
on the approvals and stuff.
And then bring someone on board. Then completely didn't know that it was going to happen. In November, you announced that you were going to buy Mineral Hill, and I was going, that's exactly what we needed.
Yeah, I still think it is. I absolutely do. We needed to de-risk the business. Our strategy from the start when we did the reverse takeover of Kingston in 2016 was to build a multi-asset asset
Yeah.
company. We want 2 or 3 mines in one company.
Yeah.
We're sort of East Coast based. We're focused I talk about it, we're east of the West Australian border is
Yes.
sort of where we look.
Yeah.
I'm West Australian. I'd love a project in Western Australia, but they're too expensive. And
Too competitive now.
And we don't have a competitive advantage.
All right.
Whereas we do over here.
Yeah.
And our number one competitive advantage today is our license to operate at Mineral Hill,
Yes.
an operating plant, and our people.
Yeah.
Right, that is our competitive advantage today because I can't do any of this. Right, our team on site, our team in this office are the guys that drive this. So that's the key. We've built the team.
Yeah.
We're building the team. We've got the cash flow generating, and we've got 2 very interesting assets. And the gold price, 4,800 and something today.
I know. I wouldn't have imagined when Kingston Resources it became incorporated in 2016. The price of gold was only about $1,700-$1,800. So
it's terrible. It's terrible.
Yeah.
In fact, so our financial year budget, we used 3,100 Aussie. That's what we thought. We were being conservative. We thought it was at the time. It wasn't I think gold was maybe 37-ish.
Yeah.
April, May, when we're putting the budget together, and you go, okay, well, what are we going to use? Look at consensus, look at the market.
Yes.
And so we obviously use a more conservative number than that. So we had 3,100, and you go, okay.
It's now 50%, more than 50% higher. I wouldn't believe that just a short period of time.
Not even a year.
Yeah.
We're not even a year. But costs have been aggressive still, right? So I was of the view that costs were settling down. I still am of that view. Drillers are being more pragmatic.
Yeah.
Equipment's getting better to get at. People are being a little bit more. I mean, the lithium and the nickel again.
Yes, that cooled off.
It took the edge off the people. Western Australia again, very unique, very busy, but it is feeling like costs are stabilising. So therefore, margin expansion for the gold space.
So with the price of oil coming down to about $66 a barrel US, compared to 3 years ago when it was 120, and it fell to about 90 in 2023, and then last year it was down to about 75. How much of that drop in the price of oil did it help with the expenses? Because that's one thing I study quite closely. Is I believe that the gold to oil ratio
is very important.
Is a 1 to 2 quarter leading indicator of operating margins of gold mining companies, and I've actually got the research to prove it.
I'd like to see that.
Yeah.
Yeah, is that right?
Yes.
Look, it helps. There's no doubt about it because we're probably, I think we're sort of $1.65, $1.70 for diesel, around that sort of number.
Yes.
We get the rebate. Brings it down. So we're probably doing $300,000 a month of diesel at the moment, a bit more, on our cost base of 4 and a bit, 4.5. So it's less than 10% of our cost base today.
Yeah.
It's important. It's a lever. It's a driver for us. There's no doubt about that. But that's our direct oil impact, right?
Yes.
The indirects is every rise and fall. Cyanide, caustic, SMBS, all your reagents, all your rises and falls are connected either through gas, ammonia, / to oil, energy prices. Oil goes up. So they all move as well. So that's the bit that people forget about with the gold sector is that we're heavy users of reagents. And this quarterly lag that you talk about, rises and falls are either 3 months or 6 months trailing.
Yes.
And that's what you'll see happen. So a lower oil price right now and gas prices pretty low too is good for us. Particularly cyanide.
And does the finance team do any form of perhaps hedging on gold, silver, or petrol, or stockpile some of these chemicals to prevent the company's exposure to these risks?
Yeah, we look at it a lot. We're currently 100% unhedged.
Yes.
We would like to keep the exposure to the upside. So we're sort of thinking about puts. And maybe a tiny forward to pay for the puts.
Yeah.
Because you can do that.
Yeah.
So that's something we are thinking about. We're in no rush, but we
Yes.
think we need to be looking at it. And the guys we talk to about that, you would know him, Sean Russo.
Yes.
Right. He is always talking about what about your oil? What about your oil exposure?
Yes.
So he's in the camp of view that we should be managing our energy costs as well.
Yes.
The other big energy driver is New South Wales electricity prices.
Oh yeah, tell me about it.
It's a shocker.
It
so
is.
when we picked up Mineral Hill, we were on a long-term 8 cent kilowatt per kilowatt hour
Right.
contract, and it rolled off.
Right.
We're at 24.
Yeah. It's nuts.
It's crazy.
For a resource-rich country,
Yeah.
we're operating like a third world in terms of energy, like energy efficiency and output.
Yeah.
I certainly hope that there is some change in the government, or at least a movement towards more common sense.
Yeah. So we're very focused on us. Coming back to the question, yes, we are looking at how to hedge or protect the upside. You won't see us do a massive forward because I see that as another liability.
Yeah, it is cost quite a few companies a lot.
Genesis, was it? Who just?
No, Regis Resources came off their Capricorn came off there.
147 million this week to clear their hedge. Now for them it's not much because they're such a big company.
Yes, the
that's
opportunity cost back then. Regis had to pay $98 million to get off that hedge. Back in 2023. Yeah.
Well, it's big money. So look, we will probably consider the board is supportive of us looking at some puts and maybe a very, very small forward to pay for the puts. And not a long one either. It'd be a short dated one that we can sort of keep rolling forward.
Yes.
We're in a rising gold price and we don't want to be flipping around the downside, but we also want to make sure everyone gets that exposure to the upside.
Yeah.
You don't invest in Kingston to be hedged, right? Yeah, you want exposure to the gold price.
Yeah, that's true.
But we've got to manage the risks.
Yeah. So it looks like there's a lot of exciting developments coming up and
busy time.
Yes, and certainly look forward to investors paying attention to seeing these things come in. And could be that same time next year, it'll be a completely different story with the share price.
I hope so. And I'm a shareholder.
Yes.
I put my first $200,000 in at 21 cents.
Yeah.
I'm underwater. I want to get it back to. So.
Yeah, that was around the same price as when I first came in.
Yeah.
But I averaged down to 11 cents or something like that.
It's good to average down, but it's now time to get a return.
Yeah, that's right.
Yeah, absolutely. I hope it doesn't take a year.
That's true. Well, Andrew, thank you very much for your time, and we'll be posting this video early next week.
Fantastic.
And our readers would certainly be very glad to hear of all these, hear about this, and then
what's next?
We'll be keeping a very close eye on what's to come.
And it's a good idea. Come in. I think we should do this. This is actually quite comfortable and easy, better than through the Teams and
I know.
Zoom.
Because you're looking at the screen, it's a very different type of interaction dynamic.
100%.
Yeah.
Thanks, Brian.
No problem. Ladies and gentlemen, then, thank you very much. This is Andrew Corbett from Kingston Resources.
Thank you.
God bless.